Hello, and welcome back to the Vancouver Life Real Estate Podcast. And also, we are filming this for YouTube. So, no matter which way you want to consume your content here today, we got you covered. So, today on this episode, we are interviewing Robert and Laurent from Safe Pacific. And it's a very interesting episode because it's something that Ryan and I are not super familiar with ourselves. So, we're going to let these guys introduce you and even give you the topic of conversation today. So, Laurent, Robert, please let us know a bit about yourselves and, of course, Safe Pacific.
Let's start.
Let's do it. So my name is Laurent. This is Robert. We're Safe Pacific Financial. We've been doing this for 10 years. And where we really specialize is in working with business owners and professionals who like to invest and who like to make money. And one of the things that we absolutely specialize in is in using certain types of whole life insurance to build a tremendous amount of wealth inside. And it's something that we really specialize in that not a lot of people know how to do, and not a lot of people, even in our industry, don't know really how to do it.
Well, most of my experience with when it comes to insurance is that you pay a certain amount every month and you're protected. That's my understanding of insurance, right?
Yeah, that's how most people think of insurance, right?
Yeah, but now I'm finding out from you guys that there's a whole lot more to it.
Totally. Yeah, I think there's kind of like the insurance. Most people, especially in BC, think insurance is like car insurance, right? You pay into it, something happens, the money pays out, and nothing happens, the money's gone. That would be in our world. That's like term insurance, which is great. It has its purposes and its uses, but there's a kind of other complete area of insurance, which is called permanent insurance, and this is more of an asset, and it can be a financial tool. So yeah, a lot of people don't realize that you can actually use insurance as an asset, build up a tremendous amount of wealth in it, and actually then leverage this tool to then purchase other assets and other investments like real estate as well.
So, I mean, I've never heard of this before. So what's the process? How do I get started with something like this?
Well, we'll back it up a little bit and just start at the beginning and say, like, why are we even talking about this on a real estate podcast? And what does this have to do with anything, right? So in Canada, there's 4 things you can do to earn money tax-free legally. Number 1, your primary residence, right? If you bought a house at 100 grand and it goes up to 200 grand, you get that whole amount tax-free. Number 2, you got your TFSA. It's your tax-free savings account. So if you invest in something and it goes up, whatever that gain is tax-free. Tax-free savings accounts are great, but they're very limited. You can put $6,000 a year into those. So really, how far are you going to get? Number 3, you can win the lotto. So lottery are no tax. It's funny, but it's one of the only things you can do that's not taxed, right? And then number 4 is life insurance. So life insurance is tax exempt in Canada. And so it's one of the only things that you can do to grow money inside of an insurance policy and not be taxed on it, right? So what do? We use a specific type. It's called a whole life participating insurance. So it comes with 2 parts to the account. So one is the actual insurance, which is your traditional, like if somebody passes away, this will pay out to the beneficiaries. But then the other part is what's called a cash value. And you can make these cash values really big, right? So we have clients that are putting hundreds of thousands of dollars a year into these policies. And because they're insurance, they're very highly regulated, they're very secure, they come with a lot of guarantees. So banks love these things and they'll loan against them, similar to the way that they would loan against a house, right? So in a house, you can take a HELOC or you can get like a second mortgage or whatever, and they'll loan you X amount of LTV, loan to value, right? So like 65, 75%, maybe 85%, but probably you'd have to be like a superstar for that. Whereas these ones, we can get you loan to value of 90 or even 100% against it because they're so guaranteed and so secure so now let's talk about this in a real estate term, right? So what do you need in real estate? You need down payments all the time, right? And sometimes your money's tied up. So you need your down payment. You also need to store that money somewhere, right? So most people will usually store their money in a checking account or like high interest savings. So you get like 0.8%, whatever, super huge interest. And another place to store your money that doesn't really get talked about so much is inside an insurance policy. So you can store hundreds of thousands of dollars or millions of dollars or tens of thousands of dollars inside one of these policies, and it can grow, right? So these things grow because the funds that are invested with these insurance companies are managed, and they earn, whatever the insurance company earns, they pay out a dividend to the people who own these funds or who own these policies. And right now, depending on the company you work with, your dividend rate is between like 5 and 6.2, 6.5%, right? So that beats the pants off a bank account anytime. Because as you're growing this money in here, when you're using it, you're not actually withdrawing the money, so that the growth continues to happen, right? So it continues to earn this money while you leverage it. Similar to in a house, right? If you're taking a HELOC against a house, the value of your house can go up. It doesn't matter that it's leveraged. The house doesn't know that there's a HELOC. The value will still go up. So these insurance policies, same thing. The insurance will continue to grow regardless if you've borrowed money against it somewhere else. So it allows you to have your money in two places, but then have constant access to money when you need these new down payments for investing with you guys.
I was going to ask, is there any kind of restriction in terms of how much money I can take out? When do I take it out? Because those amounts are typically quite specific in real estate, right? So, if I can only take out $10,000 at a time, that would be an issue. But it sounds like there might be some more flexibility.
Yeah, if you're borrowing from the insurance company directly, so there's two ways to borrow. You can go directly to the insurance company, which is the easiest. They're contractually obligated to give you the loan. So it's a one-page process. You basically if you want the loan, you basically say your policy number, your name, how much you want, and that's basically it.
They'll mail it to you.
They'll mail you the check. So contractual obligated. There's no credit check. There's no what are you using the money for. Very, 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 very easy to get the money. You set the repayment terms as well. So this is really important. So if you want to invest this in something where you're going to get your return in, say, 2 years, well, you can maybe set no repayment terms, and then in 2 years, just pay it off in one shot. Or if you want to pay it off, $100 a month, you just set, $100 a month, I want to pay back the loan. So you set the repayment terms, you can pay it off in one shot. There's no credit checks. Now, big thing from the real estate perspective, if you borrow the funds from your policy from the insurance company, it's not considered borrowed funds. So when you go to get a mortgage, if you built up $100,000 in your insurance, in the investment component of your insurance policy, you want to use that money to now as a down payment. Well, that's $100,000 is not considered borrowed funds. And like Laurent was saying there before, the $100,000 is still in the policy, earning that 6% dividend that's growing on a tax deferred basis or tax-free basis. You use the $100,000 invest in real estate. You now have in real estate growth. You have the growth within your insurance policy, plus you have life insurance as well, which is always a bonus.
Okay, I'm currently blown away by this right now.
So
this sounds phenomenal. So is there sort of a time that the funds need to be within the account to, in essence, be vested? Meaning like, okay, we want to invest, let's say $100,000 as a down payment in a year from now. Does it have to sit in the account for X amount of time? Or can you say, look, actually, I want to buy next week. I'm going to put it into your policy through the insurance and then pull it out a week later, but then still have it kind of considered to be within the policy and then have to pay it back over time?
Yeah, yes and no. Like if you're talking, like you were using an example of like a week is fast.
Sure.
But if you're using like 6 months or a year, then yes. So it's going to take a while for the money to obviously grow and be invested in the policy. In short, it depends. So like if you're using the example of 100,000 or 200,000, you can do what's called like an immediate financing arrangement, which basically they put up 200,000 in the policy. We set up the line of credit for that amount right away, usually at a third party bank. So they put 200,000 in the insurance policy. They get the loan for $200,000 like the next day. So there is a way of doing that.
It'll take like a couple of weeks, but
for sure. Now, is this something that you guys have discovered or created, or is this sort of available for a while now?
So this is how Laurent and I actually met and became connected. I was in the insurance business, and I was working with a lot of high net worth business companies, and I was learning about these strategies. And I've kind of come across like how whole life insurance is actually an asset, and it was mainly like a tool for the high net worth, ultra high net worth business owners. Laurent came from a completely different background. I'll let you
I was in not insurance. Like I was from the farthest thing from insurance. Dan, we were doing nightclubs and parties and stuff, and I never thought that I would ever get into this industry. But then when I figured out how this worked, I was like, holy geez. And I was learning, I'm like, why don't I know about this? I thought I was pretty smart. And I was researching this thing, and I watched this like hour and a half long kind of video of this guy explaining how this works.
In 2010.
And this was in 2010, yeah, right after the Olympics. And he was in Texas. And so I'm like, okay, so you can do it in the US, but like, does this work in Canada? And so I actually like called around a couple people. People had no idea what I was talking about. And then randomly, I was in the same building, like in the same office building as Rob, and he was in the boardroom giving a presentation, but the door was open and I was outside and I'm listening, and I'm like, he's saying all the same words as this other guy. And I knew nothing about insurance before this. Like I just knew what this one video had taught me. And I'm like, he's saying all the same words and it sounds the same. So afterwards I waited. And then after everyone's gone, I'm like, hey, like, who are you? And then how do you know this? And then I said, can you watch this video and can you tell me, like, are you talking about the same thing as these guys? And then so we did, and he's like, yeah, this is the same thing basically, right? Like a little bit different in the US, a little bit different in Canada, but like 95% it's the same. And then I'm like, well, why? Like, we should be doing this. Like, let me market it and you do it. And then Safe Pacific started. It kind of started in earnest around 2011, but we like incorporated in it started kind of in earnest 2010, but we like incorporated in 2011. And we've really been focused on this. And you don't have to be putting 200 grand a year into these things. You can do this for like $1,000 a month, or, any range of stuff. There's people putting millions of dollars a year into this.
Well, why wouldn't you? It sounds like it's an area, like you said, to hold your cash tax-free.
Yeah.
I mean, that's a huge advantage. The other thing I was going to ask too, if I wanted to take that loan and use that loan as, my down payment, what effective rate am I paying for that loan? Where is that determined? Oh, okay. So
if you borrow, so we were saying those two examples, you can borrow from the insurance company directly, which is like the easiest way to get those.
That's right.
You're actually obligated. It's like right one page. If you borrow from the insurance company, then they set the loan rate.
Okay.
And it's usually like prime plus a certain percentage. So I'll use an example like Manulife is right currently it's 4.75, right? So
but it goes up to like 7. Depending on the company that you're working with right now, it's like 6.5. So it's a little higher.
And so how that happens, so like, again, your money is going into like the pot with the insurance company. They're taking that money and investing it.
Yeah.
And their goal, they're say paying the dividend of around 6%. So they're basically saying, well, if we're going to take this money in this pot and we're going to go lend it to someone else and try to generate that 6% dividend for you, if we're going to go turn it around and give it to you, because they're going to take that money out of that pot and lend it back to you. Yeah. And then the interest that you're paying on that loan is going back into the pot, which is what's being used to pay your dividend. So they have to charge you it's kind of going to you in a roundabout way.
Yeah, it's a big circle. Because you're taking the money out, but you're paying the insurance company back, right? So
which is what they're using.
Which is growing and growing. Yeah.
So the whole idea though is, one is you're getting that tax advantage growth. You can leverage against it and take advantage of opportunities, which we really like it. So a lot of our clients will use it, say, as like a bullet fund. So if we use like, March as example, and with COVID, right, the stock market plummeted. So we actually were really busy with clients saying, oh, stock market plummeted. I have $200,000 in my insurance policy that isn't tied to the stock market. It's fully vested, just sitting there. Well, I'm going to take this $200,000 and now invest in the stock market.
Go buy.
So if it rebounds in 6 months, they sell and pay back their policy.
We had a couple people do really well last year.
Yeah.
So essentially, you become your own bank. You are your own lender.
That's how they market it in the States, and that's where like the big guys in the US. So if there's concepts called the infinite banking concept, which is a concept by Nelson Nash, and then there's Pamela Yellen came with Bank on Yourself.
There's a guy, Garrett Gunderson, called cash flow banking. Yeah. So all of these guys have kind of like trademarked their own version. They're all the same thing, but because you write the book, you can't call it the same as the other guy's book. You need to call it your own. There's like 20 different ways of calling this thing. And they're all the same thing. They just all have like trademarked their own website and trademarked like, you have to do it my way and my way's better. But they're all doing the same thing.
the idea is creating that asset, which is the insurance policy, investing within it, using it as kind of your initial starting point for your money, because there's all those benefits: tax deferred growth, the life insurance, the privacy, the ability to access it, creditor protection. There's tons of benefits with this asset. And then you take that asset, just like real estate, you borrow against it and then buy other assets. So it's like a good starting point. And the reason why they call it banking is because, just like the banks, what the banks do, right, is they have their pool of capital. When they want to create new money, they don't actually withdraw those funds. They borrow and create new money from the assets they're holding. And that's the idea of this concept, is that you never actually withdraw your money. And that's the problem with most savings accounts is, you build up 50 grand for a down payment or 100 grand for a down payment. When you go to buy that house, your 100,000 goes to zero. You go buy the home, and then you have to start from zero and build up your savings, and you lose the compounding effect over your entire life. Because it goes from 100,000 back to zero, and then you have to build it back up, and you build up your investments, and then some other purchase, you buy a car, you do something else, it goes to zero. And then, so what this allows you to do is that your money never, imagine if every dollar you've ever saved never actually left the account.
Well, yeah, it's almost double in a sense, right? You basically, you save your 100,000, it's in the insurance fund, but you're getting your loan at 100,000, but you didn't use any of your 100,000.
Yeah, exactly. And you just keep doing this over and over. And if you do it from like a rental, say you do it from like a real estate rental perspective, well, now that you bought a rental property that's generating good cash flow, you take the cash flow, put it back into your insurance policy, and then you just keep
pay it back.
Yeah, you pay it back, and you rinse and you repeat, you rinse and you repeat. And we call it stacking investments on top of each other.
For further clarification, if I have 100,000 with you guys, and let's say we're getting an average return of 6% a year, I can take that 100,000, and as long as that money makes at least 1% annually, you're up, right? Meaning that if it went down to zero, or no, if it went to -6, it's a break even. So as long as you're doing better than a -5, you're pretty much up over the year. Does that make sense?
Yeah, I mean, yeah. So let's say even if you're saying you're getting 6% and you're borrowing at 6%, right? Like you're saying, if you get 1%. Now keep in mind though, the 6% is also, if you're borrowing it, could be tax deductible
because you're investing.
So your net cost is actually going to be lower, even if it's even. Now, if you tie into the fact that if you're paying down that loan, right? So if you have $100,000, it's earning 6%, but then you start maybe paying down that loan slowly. Well, the interest is on a declining balance, where the 100,000 is now compounding up.
Right. Nice.
So you're actually going to
you're going like that.
So on a cash basis, you're up.
Makes sense. Yeah, I get that.
Yeah.
And there's no limit onto what you can spend that money on. Like I could pull out that 100K and buy 100K of Bitcoin, for example. Is that correct?
Yeah.
Very interesting.
So that way, yes.
Are you seeing that, by the way?
Right?
As a sidebar. Never mind.
Yeah.
Yeah, I'm just seeing what I'm interested to know what some of these people are doing with these accounts. I mean, yes, I'm interested in the real estate aspect of it, but general investment, it seems like a great investment tool. Just
so
generally speaking,
investing in the market. Some people are investing in real estate. Some people are investing in themselves. So like one, he built his a physiotherapist and built his physio studio / gym. Borrowed the money from his policy, did that. Said I'm not going to pay this back for like a while because I need to generate the cash, and then when you generate the cash, so it's whatever you want. In the book, like if you read these books, they're always like doing consumer spending with it, which you can do as well. We are more on like a investor standpoint, so we tell people to don't spend, but you can spend if you want. And then the reason that we tell them to invest is because you get to double, you get to make twice, and you come out way ahead. And then eventually, so we kind of have like two timelines. One is your working years. During your working years, we suggest invest. Then when you're in your like retirement years, whatever that ends up being, there we suggest pay out whatever that loan was, take another loan, and you can actually supplement your retirement on a tax-free basis with this, right? And then that's where you start taking loans and you don't pay them back. And what the insurance company or the bank will do is they'll just do what's called monetize the interest. So they just add the interest to the loan. And eventually, one day, you're going to die. The insurance is going to pay out. It's going to cover the loan, and then whatever's left goes to the beneficiaries.
So from
Sounds like
kind of a
from
retirement.
the retirement perspective, well, I guess sorry, from a real estate perspective, it's kind of like a reverse mortgage where you get tax-free income for the rest of your life, because it's, again, borrowed funds. And then, but unlike real estate, when you pass away, the life insurance, again, pays out all tax-free and bypasses probate, the will, and pays your beneficiaries directly. So that's like always the benefit.
Like all the regular benefits of insurance.
Wow, it goes by probate too. That's interesting.
Yeah. So
Yeah,
life
any
insurance.
life insurance doesn't.
How big of a policy do I need? Like, let's say I'm looking at a retirement sort of picture. How big does my insurance policy have to be to pay off, whatever's left, and then have something for a beneficiary kind of thing? Is there a typical standard, or
the cash value will never exceed the life? Like the life insurance is always going to grow with the cash value. So they're going to offset as the cash value of the policy grows, the life insurance policy will grow. So you'll never be able to borrow more than the life insurance payout. And then
something will always pay out.
And then for like how much,
Right.
or like what should you do? It's difficult to say, because what we want to do, and this is kind of how we work with people, is getting to know their situation, figuring out what their goals are. A retirement for someone might be $50,000 a year. A retirement for another person might be $500,000 a year. So obviously, how we structure things are different.
And then what we could do is just work backwards and say, okay, well, if you want to retire at this age with this much, then we can like figure out what do you need to get there. But it's the same with any type of savings.
Wow.
We compare it really to savings, right? Like if you want more money, save more. And you don't have to do it all at once as well. Like we've got clients that have like 10 policies, right? So we met them, they were at the beginning of they'd launched their company and they're like, I can't put in that much, but I can do this. And then as they get bigger and bigger and bigger, they just add more. Right?
So if I already have a term life policy, can I just start doing this?
Not with a term policy, you can convert it. So with term insurance, usually it depends what company it's with and all those sorts of things, but usually you can do what's called convert the policy to a permanent insurance plan. So you can switch it from term insurance to a plan like this, where now you can start using it as a sort of like a tax sheltered vehicle.
But not all companies allow you to add the extra cash from a conversion. The answer is maybe.
Right.
Or you just
set up another one. If you're healthy and you can get insurance, that's probably better to just set up another one.
Got it. And so for further clarification, so do I need like a policy with you guys for X amount, and then that kind of gives me access to be able to borrow against another policy, or can you just kind of put money in and take it out, like I said, within a reasonable amount of time as well?
Yeah. So what we do is we just set up a new policy, which is structured in this way, where we're going to back up. Like the policy has to be structured in a way. It's not like you're run of the mill. You can't just go off the street and get, there's lots of
insurance advisors won't know how to set these up this way.
Yeah.
So the way we set it up is specifically designed to get the most amount of cash value in it. And we want to build the cash value as big as possible, because that's what we're leveraging against.
So most people, when they set up life insurance, they say, okay, you want to get as much life insurance as possible and pay as little for that life insurance as possible. And so the way we structure it actually is the opposite. We say, okay, we want to get you obviously, that however much in life insurance you need, but we want to put as much cash into the policy as possible. Yeah. And there's a limit of how much cash you can put in based on the life insurance amount. So we figure out kind of how much cash you can put in, and then we get right up to that limit of how much cash you can actually shelter in these policies. So what ends up happening is the cash value, or the investment component of the insurance, is actually way larger early on. And then that's what you can access right away. So we don't want to just say, any insurance policy you can just do this with. It has to be a specifically designed permanent participating whole life insurance policy. So
that's where you guys come in.
Yeah, it's important that you talk to the right people and it's structured the right way, because then you're going to have access, like you're saying, you're going to have access to the money right away. Where if you structure it another way, it might be like 10 years before you can even have access to some cash.
This to me needs to be not seen as insurance. Like to me, like the problem I think a lot of consumers have with insurance is, especially young consumers, is that they think that they don't need it for whatever reason, right? And if you like marketed this in such a way that this was like, you don't need your own bank. Like, this is a financial asset tool. It's not insurance. Like,
That's what
to me, that revolutionizes what we're talking about.
Yeah,
They've
that's
done a
why
good
all
job
those
in the
guys in the
States.
US, they bend over backwards to like not call it insurance. They
Interesting.
use all these,
Yeah,
they
it's-
all have all these names, right?
Infinite banking or the and assets are really
The
good.
and assets are a really good one.
It's good example, right? He calls it the and asset because it's an asset, but it comes with this and it comes with that, and it has all these other benefits. So it's really, it's a mindset shift away from, it's not just insurance, it's an asset and it's a financial tool.
If I'm borrowing the money and I'm paying, let's say that 5% sort of interest on it, is that interest a write-off?
If you're investing it.
Yeah.
If you're spending it, no.
So hold on.
Yeah.
If I wanted to invest it, say, in a kitchen reno, is that considered an investment? Because I mean, theoretically speaking, I'm improving the value of my space, right?
That would be your accountant.
Yeah, is it your primary residence?
Yes.
Is your primary residence?
Yes.
That's a good accounting question for sure.
Yeah.
It's no different than any other loan, right? Like if you're taking a loan to invest in Canada, then you can deduct the interest.
Yeah.
Now that's something where you bring up with your accountant saying, hey, I took $100,000 loan, I used it to invest in X. It's just a filing for your taxes.
Yeah.
The reason I bring it up is because I'm looking at renovating my place right now, just as an example. And I went to my bank and got a HELOC, right? And that was just how I thought about doing this. I didn't want to use my money. I didn't have to, right? Didn't want to tap my capital. But it now sounds like to me that there's even a better option than that.
This is essentially a HELOC on your insurance, right?
That's right.
Very similar. It's like you're doing a Smith maneuver with your insurance.
That's right.
And it's kind of crazy when you start researching the history on this as well. One of these insurance policies have been around forever. Like Sun Life was started by John A. McDonald, same with Manulife. They're older than Canada, but the people that have used their insurance policies to fund these sorts of things and invest. So if you look at, like, we have a letter from Jimmy Pattison. So Jim Pattison started his car dealerships with his life insurance policy. Exactly this.
Get out.
Yeah,
The first
Wow.
one. The first one.
JC, and he has a letter basically saying if I didn't have my life insurance policy, the bank wouldn't have given me a loan. J.C. Penney floated J.C. Penney with it. Walt Disney started Disneyland with his life insurance policy as well. So
how do we not know these stories? These are huge corporations that touch everybody's life. It's like,
because banks wouldn't give them the money, so they have crazy stories where like no one will give them the money, but they go to their life insurance policy and there's
cash in there.
There's cash, and they're contractually obligated to get the loan. So now the bank's going, or the insurance company's like, has to give them the money that's there, and they can now use that $100,000 to start Disney, which is crazy.
Wow.
Unbelievable.
The one was during the Great Depression. He actually took a loan to pay his staff.
wow.
It wasn't to start the company, but it was
That's
like to
incredible.
pay staff so that they didn't go bankrupt.
Yeah.
And
Well,
then-
I have to
business
say,
manager too.
you guys have absolutely piqued my interest, and I know I want to set up a meeting with you and talk about options here. I would absolutely be certain here that some of our listeners and viewers will too. So please, what is the best way for people to get a hold of you to find out more?
They can go to our website, safepacific.com, easily fill out some information there, or they can call or email us. You can email Robert at SafePacific or Laurent at safepacific.com.
Do you guys have a social media handle at all or anything like that?
Yeah, everything is at Safe Pacific. So Instagram, Facebook, YouTube, LinkedIn, those are our big ones that we use. And we're on there all the time, so we'll reply. But
Amazing.
if you really want to get a hold of us, just go through the website, just go on the contact page. That comes straight to us. You'll get a reply like within 24 hours.
Amazing, guys. I'm sure this is a much deeper conversation to have with a lot of people one-on-one, but like I said, everything you shared here is extremely exciting.
Yeah.
I'm super interested. I'm looking to get set up with you guys. So thanks again for your time today, and we will direct our clients your way for sure.
Awesome. Thanks for having us. This is
Yeah.
great.
Thanks, guys. This was awesome.